Welcome to Module 7, Cost, Volume, Profit Analysis. All right, before we jump into it, let's get a little context. So, if you remember our US GAAP financial statements, which in the next module we're going to call absorption financial statements. You don't have to remember that now. I'll talk about it next module. But our traditional income statement is sales minus cost of goods sold equals gross profit. And then we subtract our operating expenses to get net income. Remember, our operating expenses are really our period costs, right? Anything that we didn't put into COGS is going to go down here. And that was our traditional income statement, and it serves us really well for external reporting purposes. With cost, volume, profit analysis, we're going to split things up a different way. Instead of having cost of goods sold and operating expenses, or product costs and period costs, we're going to split between variable and fixed. So our income statement under cost, volume, profit analysis will be sales minus variable costs equal contribution margin, which we'll learn about, minus fixed costs equal net income. And in this way, by splitting out the variable and the fixed costs, we can start doing some different kinds of analysis for internal purposes. And the reason we do this is because our fixed costs are fixed. We can't change them, right? So when we're budgeting, when we're saying how much do we want to sell, what do we think we can sell given market demand, we can control to some extent sales and the variable costs which will go with it, but the fixed costs are going to stay the same. So if we can split out our fixed and variable costs, we can do some cool different kinds of analysis. What kinds of analysis, you asked? Let me tell you. Okay, before we can start our analysis, we need to figure out a way to split out our fixed costs from our variable costs. Now, if we have a really big, expensive computer program, it can probably do this for us, but we're going to learn how to do it ourselves. There's a few different methods. There's something called a scattergram, something called regression analysis. That all sounds way too mathy for me. So we're going to use something called the high-low method. And when we talk about this method in the module, we're going to learn how we can take the period that has our highest level of production value and the period that has our lowest level of production value and look at the number of units we produced in each and the cost to produce those units, and we can come up with some formulas to separate out what portion of our costs are fixed and which portion of our costs are variable. So that'll be cool. Then we're going to learn how to calculate contribution margin and the contribution margin percentage. The contribution margin will just be sales minus variable costs, and the contribution margin percentage will be our contribution margin divided by sales. And we'll get into that some more. We're going to use that. The first thing we're going to do is figure out break even. Break even is the point where we have covered all of our costs, both fixed and variable, but we have not made any profit yet, right? So it's like the bare minimum we'd have to make to stay in business. And we want to understand what that is, because imagine if we figure out our break even is 200,000 units, and then we look at market demand and we only think we can sell 150,000 units. Well, then this idea is going to be, we're not going to want to do it, right? So we need to understand at what point would we start making money to make sure that market demand is such that we can actually make money. Once we do that, then we can look at a safety margin. And I think a safety margin is like a buffer. And it really is like, for example, it usually takes me 35 to 40 minutes to get to campus, back in the good old days when we went to campus. But that doesn't mean I left 40 minutes before my class started, right? Usually I leave about an hour to give myself a buffer in case I hit all of the red lights, in case there's an accident. And that's exactly what safety margin is. And we can either do dollars or a percentage. So we can figure out, if we think we're going to make this much in sales, how much of a buffer or a safety margin do we have over our break even? If we don't know the number of sales, then you do a safety margin percentage. Let me back up. We can also do a safety margin percentage and say, hey, we think we're going to have a 10% buffer or a 10% safety margin. If we know that we want a 10% buffer, we can also use that 10% safety margin to calculate our target sales. Okay, so we know our break even is at 200,000 units, say it's $200,000. And if we want a certain amount of a buffer, then how much do we have to sell to make sure we have that buffer? Just in case something goes wrong, like, you know, a global pandemic. All right, then we're gonna look at operating leverage. And operating leverage tells us how sensitive our net income is to, our net income is to a change in sales. And it has to do with the proportion of fixed to variable costs. So if you think about it, if I have a lot of fixed costs, at some sales level, I've covered all of my fixed costs, and if I have a lot of fixed costs, presumably I have a lower variable cost per unit. And so then that means that everything after that, it becomes a lot of profit, right? Because my contribution margin is high. Whereas if I have a lower contribution margin, if my fixed costs are variable, then I have a lower contribution margin and presumably lower fixed costs, then it would be that maybe I'm not as sensitive to changes, right? Once I hit my fixed costs, my net income doesn't go up as much when my sales go up. Same thing when my sales go down. There isn't one right or wrong answer, but by understanding the operating leverage, you can kind of understand how much of my at risk if my sales forecast is really, really wrong. Okay, and then the last thing we're going to talk about is composite units. So most of what we're going to do is assuming that we have only one product. But in reality, most businesses have multiple products. And the question is, if I have multiple products, how do I figure out my break even and my safety margin and my target sales and all of these things? Because different products will have different sales prices, they'll have different variable costs, they'll have different contribution margins, and this could give you a headache all night long until you know how to use composite units to basically take all of your different products and bundle them into one product or one composite unit that then works exactly the same for calculating contribution margin, break even, and all of these other things. Okay, so it's an exciting chapter. We have a lot to do. It goes pretty fast. We're going to go through a lot of examples together. So go to your worksheet. If you have a printer, I suggest printing it out so you can take notes not only on the answers, but how we got the answers. If you don't, then go ahead and just pull it up on the screen and fill it out the best you can that way. All right, I know you're excited to dig in. I'm so excited to dig in, so let's just go do it.